Welcome back to our series of videos about capital allowances. Today I'm going to look in more detail at the rules introduced by Finance Act 2012, now found at sections 187A and 187B of the Capital Allowances Act. We've already seen how these rules impose the pooling requirement and the fixed value requirement. But those requirements are not always imposed, so we're going to take a look at the conditions that determine whether or not they apply in any given case. To set the scene, the conditions in question are at subsection 1 of section 187A. Now the first condition is relatively straightforward. The new or current owner must be treated as the owner of the fixture as a result of incurring capital expenditure on its provision for the purposes of a qualifying activity that he is carrying on. So, to give a rather obvious example, the rules have no relevance for a person who buys a property as a trading asset to be sold on at a profit. Jumping for a moment to the third condition, this concerns contribution allowances and is a very specific point that need not normally trouble us. The second and fourth conditions are closely linked and are best viewed together. Between them, they impose a number of sub-conditions, which we can summarize as follows. The pooling and fixed value requirements will only apply if a past owner incurred capital expenditure on the fixtures in question for the purposes of a qualifying activity, if the past owner owned the property at a relevant earlier time, and if the past owner was entitled to claim plant and machinery allowances. The relevant earlier time does not include any time before the 1st or 6th of April 2012 for corporation tax and income tax purposes, respectively. So let's look at three fairly simple examples of when the rules will not apply, either at all or in full. The first concerns the purchase of a warehouse from a property developer. The property was completed in February 2014 and is being bought from the developer in April 2015. No past owner has incurred capital expenditure, and so no past owner has been entitled to claim capital allowances. Therefore, the pooling and fixed value requirements are not imposed. The second example concerns an office block that was built in 1998. Owned originally by a commercial landlord, it was sold to a pension fund in 2009, and the pension fund is selling it in 2015 to a company that generates rental income from a portfolio of properties. In this case, the only past owner since April 2012 has been the pension fund. As the pension fund does not pay tax, it's not entitled to claim capital allowances. Therefore, once more, the pooling and fixed value requirements are not imposed. For the last example, let's suppose that a care home is being sold in 2015. It's been owned since it was built in the year 2000 by a company that has operated the home and is now being bought by another trading company. In this case, of course, the pooling and fixed value requirements are imposed in respect of most of the expenditure. However, the past owner will not have been entitled to claim for those integral features for which no relief was due before 2008, for example, general lighting and electrical wiring. So, most fixtures will be subject to the pooling and fixed value requirements, but the integral features will not be subject to those rules. Now there's more to be said about sections 187A and 187B, and we'll therefore return to these next week.